Hi friends, I welcome you all on our second video on Oman VAT. So today we will be discussing upon chapter 1, article 1 of the Oman VAT law that will be going to be implemented with effect from April 2021. So all the important definitions like taxable persons, exempt supplies, taxable supplies, threshold for registration, voluntary registrations, intra-GCC supplies, inter-GCC supplies, input tax credit. So all these important and relevant definitions we will today cover in our video. So let us start. So the first definition that we will be going to discuss in Article 1 of the Oman VAT law is taxable person. So a person who conducts an economic activity in independent capacity with the aim of generating income and is registered with the authority or is required to register with it in pursuant to the provision of this law. Right. So a taxable person is a person who is doing any economic activity, right, for the aim of generating income. Second is mandatory registration threshold, right? So the minimum value of actual supplies by virtue of which the taxable person shall be obliged to register for tax purposes. In our coming videos, we will be covering a separate topic on registrations. So we will be covering all the registration part, the threshold and voluntary registration in detail. So as of now, mandatory registration is a threshold uh, exceeding which, so this is a minimum value of supplies which is defined in the law, after which the person has to take registration. Now, third is voluntary registration threshold. This is the minimum value of actual supplies by virtue of which the taxable person shall be eligible to register for tax purposes. So, in voluntary registration, the taxable person, even if uh, the threshold, for example, to say if the threshold is set for 35,000 rupees, right? So this is the mandatory threshold. Example to say that, but for voluntary registration also, it is not like if your taxable supplies or if your supplies value is say 10,000, you may apply for registration. So for voluntary registration also there is a minimum value. So if the minimum value is defined in law is 15,000, you can take voluntary registration only if you cross that 15,000 limit, right? So it is not like if you have started your new venture and you take the registration. For voluntary registration also there is a threshold limit which we will discuss later in our videos, right? Now comes the fourth part, tax return. So all the details and information specified for the tax purposes, which is required to be submitted by the taxable person in the form which which will going to be prescribed by the authority shortly, is the tax return. So basically the VAT return that the VAT return that needs to be submitted by the taxable person to the VAT authorities. Now tax invoice. So as we know, the VAT is going to be implemented with effect from April 21. For tax invoice also we will be coming up with a separate video. So tax invoice definition is the any document written or electronic form required to be issued by the taxable person containing details of the suppliers in accordance with the provisions of this law. So basically, a tax invoice is an invoice that the taxable person will give to the customer that that to the tax to the customer, which will show the VAT number of the supplier, the address, the quantity, description of goods, rate, amount, right? So the tax invoice is very important because because tax invoice, on the basis of the tax invoice, your customer or your recipient will be eligible for the input tax credit. So it becomes very important that the tax invoice issued by the supplier is within the law, within the provisions of the law, right? Next comes the input tax. So the tax incurred by the taxable person in relation to the goods or services supplied by him or imported for the purpose of conducting activity. So let us connect tax invoice and input tax. So if A sells the goods to B and A charges 5% of VAT on 100 rupees value, right? 5 rupees is the tax amount. So the recipient B, which has paid A 105 rupees, will get the credit of VAT that has been charged by A. So that 5 rupees is the input tax, right? So I'm reading again: the tax incurred by taxable person B in our example in relation to the goods or services supplied to him. So supplied to him by A, right? So this is the input tax credit, right? Now comes the intra-GCC suppliers. So supply of goods or services by a supplier that has a place of residence in the Sultanate to a customer resident in GCC state or vice versa. So as we know, GCC, Gulf countries. So if there are transactions between the GCC countries, we call it intra GCC suppliers. And if there is any kind of transactions other than the GCC countries, we call it inter GCC supplies. So taxable supplies, supplies in which tax is imposed at the standard or zero rate, and the input tax credit thereonto is deductible in accordance with the provision of this law. Right. So taxable supplies are those supplies on which tax at the rate 5% VAT is going to be charged. Right. And uh, the person is also eligible for the input tax credit that we have discussed in the input tax credit part, right? So what are exempt suppliers? Now this is very important. In taxable supply, the supplier who is charging 5%, right? The recipient is getting the credit, right? And the supplier is also getting the goods or services from the other supplier, right? So in our example, A must be also taking supplies from another person, maybe Z, right? So in exempt supplies, the tax is not imposed and input tax credit is also not deductible. So for exempt suppliers, your output is zero, and whatever your inputs are there on which you have paid VAT, you will not be getting any credit of the VAT that you have paid for your supplies because your output is zero. So you will not be getting any benefit of input tax credit. So that will be your cost, right? Now, this is deemed supply. We will be discussing in detail in our coming videos. Consideration is all that is collected or going to be collected by the taxable supplier from the customer or a third party for the supply of goods or service, including of tax. Now, reverse charge import and export. So, in reverse charge mechanism, in the normal scenario, we have seen the supplier charges VAT on the suppliers, and the recipient pays that VAT and the consideration amount to the supplier, and supplier is liable to deposit that VAT to the government. But in reverse charge mechanism, the supplier is not liable to deposit the tax to the government. The recipient is liable to pay the tax to the government, not the supplier. So the mechanism under which the taxable customer is liable to tax on behalf of the supplier and responsible for all the obligations stipulated in this law. So the recipient is liable to deposit the tax, not the supplier. Now import. Entry of goods from outside the GCC region into the Sultanate in accordance with the custom law. And export. The exit of goods from the Sultanate from Oman to outside the GCC in accordance with the provision of customs of law. So these are the important definitions. There are also many other definitions and which needs to be discussed. But these were the important definitions. So I request you to please subscribe our channel for getting regular updates on Oman VAT, right? And we will be soon coming with another video on transitional provisions so that all the businesses can get prepared about the VAT law. So thank you so much.